Welcome to the ETF Education Series brought to you by ASX, BetaShares and CommSec. I am Jacinta King, Business Development Manager, Investment Products at ASX, and I'm joined in studio by Ellie De Vere of BetaShares, where she's Director. Hi, Ellie.
Hi.
And also Stephen Daglian, who is a Market Analyst from CommSec.
Thanks for having me.
Now, this is the first of 4 short series where we are going to discuss exchange traded funds, or ETFs as they are commonly referred to, and we'll unpack what they are and give you some more information to understand them better so that you can make an informed decision should you choose to invest using ETFs. So Ellie, we're going to start right at the beginning. What is an ETF?
Great place to start. So ETF stands for Exchange Traded Funds, and it is a portfolio of investments that trades on a stock exchange, including the ASX. So ETFs typically aim to track an index, and that index can be comprised of companies, fixed income, cash, or commodities. So they provide investors the opportunity to gain access to this whole world of investment opportunities that they may not have been able to access before.
And they're bought and sold in the same way that you do a share, right?
Yes, they are. So the accessibility of ETFs is one of their kind of primary benefits, I suppose. Yeah. Rather than having to fill out, mountains of paperwork and wait an extended period of time, you can buy ETFs as you would a single stock. So, BHP Woolies through an online broker or your financial advisor.
So it sounds like there's a level of simplicity. And then, so why do investors buy ETFs?
For a number of reasons. The primary one is definitely the diversification element. So when we think of an ETF, think about you're going shopping at a farmer's market. I always like the fruit basket analogy. And you're going along to your grocer, and rather than purchasing one apple from your grocer, you still make one purchase, but you get your whole basket filled up of a variety of different fruit. So think about the fruit basket as your ETF portfolio.
It's a good analogy. I use that one too, actually, especially family and friends who are new to this space.
And you love fruit, obviously, Jacinta, which
Healthy.
is why you use that one, of course.
Yes, that's right. Now, is there a minimum trade size with ETFs?
No, there's not. So there's no minimum trade sizes set by the ETF manager. However, every broker has different trade size limitations. So it just pays to check with your broker first, because it does vary from broker to broker.
Stephen, I might get you to talk about the net asset value for us, if you could explain what that is and why it's important.
Yeah, so the NAV, the net asset value.
Another acronym for
another
us.
One, another one to enjoy.
Yeah.
There are way too many, but it is an important number because it basically measures the market value of the assets in the ETF, taking away things like liabilities as well. So it's an important number. It's often expressed as a dollar value per unit. So the reason why it could actually be useful for some investors is you can look at the NAV and you want that to be relatively close to what the actual trading price of the ETF is on the share market or the exchange traded fund, that the price you can actually go in and buy and sell at. You want that to be relatively close to show that you're buying it at a fair price. So you can find that on the broker's website often, like CommSec. You can find it on our website, but also with an ETF provider. They generally have that information on their website too.
And Ellie, I believe there's a cost efficiency as well.
There is. So when you're thinking about costs associated with ETFs, I like to put them into 2 primary buckets. So the first bucket, you've got the management costs associated with actually owning the ETF. So all those fees are outlined on the ETF manager's website. So you can go and check those so you know exactly what you're going to be paying from a management cost perspective before you invest. And then the second bucket is the cost associated with actually buying the ETF. So brokerage fees, essentially.
Yeah, and the PDS too will outline and have some details on that and some examples, which I think is always helpful to have worked examples.
Exactly.
So with all investment, there are risks, right? Yeah. So we must consider them. What are some of the risks, Stephen, when investing with ETFs?
Absolutely. Market risk is probably one of the key ones because a lot of ETFs, as you pointed out earlier, they're tracking something, right? They're tracking the Aussie or US share market or other markets. They're tracking commodities. They could be tracking a certain sector as well, like healthcare, for example, or even themes. And there are so many of these, right? There's everything from sustainability to AI to the metaverse and even things like crypto as well.
Cybersecurity, everything.
Yeah, exactly. There's so many.
Spoils the choice, really.
Yeah, exactly. So the risk here is that the value of that underlying asset or investment falls. Regardless how cost effective or simple it is to trade, an ETF, that's always going to be a risk. So if the Aussie share market has fallen by 25% over the course of a week, and the ETF's one job is to track the Aussie share market, you rest assured it's going to be a rough week for that ETF. Another, I think, which is often overlooked is currency risk, because we don't really think about that so much, I think, often, because if you're investing in Australia, tiny portion of the global market, roughly 2%. But if you look overseas where there are many or more opportunities, the more experienced people get especially, you don't only have to think of the investment risk, you have to think of movements in currency and at least be aware of that, because that can make your investment look much better or much worse. And there are ways to get around this to give you some peace of mind, generally at a high cost. There are currency hedged ETFs where the manager tries to take away that risk out of the equation. And as I said, it's at a high cost. So I think you mentioned fruit, which is delicious, and cars, of course, are also, I don't know if they're delicious, but they're definitely useful.
Appealing.
They're appealing for some people.
Everybody
right?
can relate to it. Everybody likes the car they buy, right?
Exactly right. So you
spend
could
a lot
buy
of time
one would
thinking
hope.
about it.
Yeah, so you could buy an entry-level model of a vehicle, or you could buy one with all the bells and whistles and something fancier with a sunroof,
And the leather seats.
leather seats.
With warmers.
Yeah.
Exactly right. So you could do that, and obviously that's going to come at a higher cost, but it might give you, some peace of mind and enjoyment from it. So it's kind of the same with an ETF. The more work a manager has to do, the more they add to it, more components, the more managing there is. Generally, the cost is higher. So over a very long period of time, that's something you have to at least consider if it's worth it for you.
And what about the fund-specific risk?
That's another one as well, because obviously behind an ETF there is a manager, and when there's human involvement there's always a risk. So tracking risk is one of them. You want the ETF provider, I guess, to be doing their job and to actually track what they say they'll track. So if they want to track the Aussie share market, you want them to do that effectively. There are also actively managed funds, which we won't get to too much, but basically this is where the manager is trying to do better than something like the index, or better than a market. And the risk there is that they don't do better, So that's something to just consider as something to take on board. And liquidity, very quickly, is another one. You just want the fund, the ETF, I guess, to be large enough to be enough buyers and sellers going through there, so it's easy for you to get in and out when you want to.
Ellie, Stephen, thank you for your time providing that introduction overview to exchange traded funds.